Hello and welcome to Live and Ascend. Today I will help bring clarity to two popular long-term investment vehicles, ETFs and mutual funds. Let's begin. Here are some early key takeaways. The U.S. market opens at 9:30 Eastern and closes at 4 p.m. Eastern. Both mutual funds and ETFs hold portfolios of stocks and/or bonds, and occasionally something more exotic, such as precious metals. Both can track the actual stock market as well. However, ETFs tend to be more cost-effective and easier to get your money out at a drop of a dime. ETFs trade directly on exchanges like shares of stock. Mutual funds can provide some benefits, such as having an active fund manager and greater regulatory oversight, but only allow transactions once per day and tend to have higher costs. Exchange-traded funds, ETFs, as the name suggests, exchange-traded funds trade on exchanges, just as common stocks do. At the other side of the trade is an actual investor like you, not the fund manager. Unlike mutual funds, you can buy and sell at any point during a trading session, at whatever the price is at the moment and not just at the end of the day. Another key difference is that most ETFs are index tracking, meaning that they try to match the returns and price movements of an index, such as the S&P 500, by putting together a portfolio that matches the index underlying companies as much as possible. Index tracking ETFs have lower expenses than index tracking mutual funds. Any purchases along with the cost of a mutual fund is based on its price when the market closes that day. The cost can be based on the next day's end of market price if you place your order that same day after the closing bell. When you sell your mutual fund shares, the same process occurs, but in reverse. Some mutual funds will charge 1% of the share's value for selling early, typically sooner than 90 days after you bought in. The bottom line, given the distinctions between the two kinds of funds, which one is better for you? It depends. Each can fill certain needs. Mutual funds often make sense for investing in complex yet potentially rewarding areas like market neutral or long-short equity funds. But in most situations, and for most investors who want to keep things simple, ETFs, with their combination of low cost, ease of access, and emphasis on index tracking, may hold the edge. Their ability to provide exposure to various market segments in a straightforward way makes them useful tools if your priority is to accumulate long-term wealth with a balanced, broadly diversified portfolio. As you can see, either one or the combination of the two can benefit you as a long-term investor. I hope this video helped. Take care.